Crises don't come out of nowhere, whether it's a financial collapse, a market crash, or a real estate meltdown. There are always signs, patterns that repeat again and again. Before a depression grips the world, before a bubble explodes, before even a superpower falls, the same dominoes fall in the exact same order. Most people ignore the warning signs, but once you've seen the pattern, you can't unsee it. This video uncovers the common threads that connect every crisis, no matter what the type. This is where all the warning signs intersect, across money, markets, and empires. It's a collection of the most urgent, most revealing videos I've ever made, brought together for the first time. This is what always happens before a crisis. What triggers the most devastating recessions? Those that go beyond just a mere bubble bursting and lead to a full-blown financial crisis. Examples like the 2008 crisis, where mortgage delinquency surged by an astonishing 657%, resulting in the implosions of banks like Lehman Brothers, who had total losses of $691 billion. Or consider the Great Depression, which left 25% of the workforce unemployed and forced those who retained their jobs to endure pay cuts averaging 42.5%. Imagine waking up to a stock market crash, watching your investments drop, and seeing your savings at risk. It sounds terrifying, right? And it is. But this has happened before, and there are clear warning signs that predict a financial crisis. From asset price bubbles to bank defaults, history offers clues. In this video, I'll share the key signs that a financial meltdown is on the horizon and what you can do to safeguard yourself. This is what always happens before a financial crisis. But before we get into the video, my name's Nolan Matthias, and if you want the truth about finances, the real truth, then this is the place for you. So if at the end of this video you found it useful, you found it insightful, and it gave you some actionable tips in order to help safeguard yourself against the next financial crisis, then do me a favor, hit the like button and subscribe. Oh, and tell me what you think. Are we headed for another major financial crisis? Or is this just another recession that's on the horizon? Okay, so in this video, we're unpacking what always happens before a financial crisis. And to be clear here, I'm not talking about your everyday recession, your run-of-the-mill recession, or an asset bubble bursting. I'm talking about real financial crises that can lead to devastation all over the globe. There is a very clear distinction between a recession and a financial crisis, and there are some things that always lead to an actual financial crisis. But before we can understand that, we need to understand the difference between a bubble bursting, a recession, and an actual full-blown financial crisis. Now, even though a recession can trigger a financial crisis for an individual, a recession is not a full-blown financial crisis when you look at it from a global perspective. So it's important to understand the difference. Things like the tulip craze, which I'll talk about in a little bit, and things like the dot-com bubble burst aren't necessarily financial crises. They can definitely lead to recessions, and they often do, but they aren't the real big problem. You see, when a bubble bursts, it's simply an overvalued investment that's collapsing. Take all of those whatever.com companies that were raising tons of money on the stock market but had little to no profits and no real future prospects of profits. Well, that was the epitome of a bubble bursting. It was a craze where everyone started investing in tech stocks because that's where all the money was being made, and that inevitably led to a pretty big disaster. But not the kind of disaster that we're talking about when we talk about a financial crisis. Now, a recession on the other hand, and yes, the stock market burst was definitely something that led to a recession, although not as severe as the 2008 financial crisis. A recession is when the economy just gets bad. It doesn't mean that everyone loses their homes and everyone loses their savings. It just means things get a little bit harder for a while. And typically it is defined by 2 quarters in a row with negative GDP. And this can often be fixed easily by just having the central bank reduce interest rates, which spurs on the economy and everything gets back to normal. But then there's a financial crisis. And this is when everything collapses. And this is what we're talking about today. And much like an investment bubble, there are some clear signs that lead to a financial crisis. In fact, one could argue that a financial crisis is very much a bubble that has gone way beyond what a normal bubble looks like and turns into an economic meltdown. So let's talk about the anatomy of a financial crisis. Yes, there's always bubble-like asset inflation. 2008, think about what was going on with real estate. The Great Depression, 1929. Think about what was going on with stocks when everybody was buying them, thinking that all the money was available to be made and that there was no prospects of prices coming down. And that is the beginning of a potential financial crisis. But here's the real differentiating factor. It's when there's a debt-fueled buying craze. It goes beyond just people sticking their money into stocks or sticking them into tech stocks or buying homes with cash. It is when debt is fueling the buying frenzy. And then inevitably there's a sudden decisive shift in confidence, which leads to a scarcity of buyers. And obviously we all know what happens when everyone owns things that nobody else actually wants. The values of those things go down and plunge to the floor. But the difference between a bubble and a financial crisis is when people start buying based on debt, and when the value of those assets goes down substantially, they don't have the money to pay back the loans, or they don't have the money to make the payments on them. And to me, there's one clear sign for this. When everyone starts telling me that you need to invest in something like gold or Bitcoin or tech stocks or buy real estate because it will only ever go up in value and you can buy it and have somebody else pay it off and everything will be just fine, that's usually a sign that a bubble is about to burst. And when people start saying, hey, don't worry about borrowing money to buy it because it can only go up in value, well, that's when things get crazy. And that's what leads to a financial crisis. In fact, to put it really succinctly, it's when the stupid of the stupidest start buying into an investment idea and plowing all of their money into it. That's usually a pretty good sign that it's time to get out. Now, recognizing asset bubbles is actually not as hard as you might think. From tulips to tech stocks, speculation is what drives these crazes. I mean, just think of 1999 when everyone was buying companies like whatever.com, but none of these companies actually had any profits. But people sitting in coffee shops and bars were talking about their next big investment or their secret tip, and everyone was plowing money into these investments. It was pretty obvious that the value, the fundamentals for investing in them weren't there, which should have been a sign to most people that maybe it wasn't a good idea to buy. And these economic signals are often hidden in plain sight. You all remember the movie The Big Short, right? Well, do you remember the stripper scene? When the stripper, while dancing, was talking about all the properties that she owned and that she clearly could not afford.
What do you mean all your loans? We're talking about 2 loans on 1 house, right?
There's 5 houses.
It's that kind of craziness that's a pretty good sign that a bubble is brewing. And then when you add in the debt components of it, of borrowing the money to buy those investments when everybody else is doing it, well, that's the fuel on the fire that will lead potentially to a financial crisis. And there's also leading indicators to this. Things like the LEI, the Leading Economic Index. Now, the LEI is put out by the Conference Board, and it has 10 components, which are typically an indicator of a recession. And you can simply go on their website and look at the monthly forecasts and see whether or not we are in a place that could potentially lead to things turning the other way. And I'm not going to read you the 10 components of the LEI, but these are all very much leading indicators that could indicate that trouble is brewing ahead. And when you take a look at the LEI chart, it's very clear that there are often warning signals and recession signals that are in plain sight. And the red lines indicate that yes, indeed, there is a recession signal there, which typically means that we're already in a recession. Now, not always, but typically. So when you know what to look for, the signs are almost always clearly there. Now, when it comes to a financial crisis, yes, that is almost always a recession. But there's some clear differences and some things you can look for in order to see a financial crisis coming where it may not be so obvious that a recession is on the way. So let's start with one of the clear warning signs, and that is speculation. And one of the best examples of this is the tulip bubble of the 1600s. Now, in the 1600s, tulips were often a symbol of wealth. In fact, in many cases, having one tulip meant you were rich, and having multiple tulips meant you were extremely wealthy. And of course, tulips really only bloom in the spring, which meant it wasn't something that you necessarily had year-round. But some really savvy investors decided that they were going to sell futures on tulips, which led to speculation over the price of tulips in the future, and that ultimately led to a disaster. And it's a disaster that we can use in order to understand the psychology that will lead us to be able to identify future crises. Because when everyone goes crazy and starts buying tulip futures, something that you can literally grow on your own, but you're buying the ability to own, when a tulip at the end of the day really doesn't have any other value than maybe perhaps a little bit of status if you were back in the 1600s, well, that's a pretty obvious sign that we've got a bubble brewing. It's exactly that. It's when things have more value than what they should, and everybody is buying them and propping up the price. That's when we have a bubble on the way. Now, the good news is in the 1600s, this didn't lead to any sort of disaster. It didn't lead to any sort of financial crisis. But the speculation piece is a case study that we can use to identify future major issues. And the lessons from this are really simple. Markets and economies that are built on speculation are vulnerable. Think about Bitcoin right now. It is built on speculation. Yes, there are some valid arguments to own it, but at the end of the day, most of the speculation has to do with the collapse of the US dollar and being independent of governments that could do really bad things. But for somebody to take all of their life savings and put it into Bitcoin when it is very much an asset that is in fact based on speculation, well, that's absolutely crazy. But when the majority of people start doing that, that's typically how you know that a bubble is brewing. And whether it's tulips or technology stocks, the speculation is what fuels the crashes. But the debt is what turns them from crashes into all-out meltdowns. And there's almost always speculation happening all around us. And it is that speculation that creates financial bubbles. And the lessons from the past can really guide us from today. Take, for example, there are danger signs brewing in the gold market. And they are clear as day if you know what to look for. The price of gold almost always follows the exact same speculative patterns. And the pattern is this: when consumer confidence falls significantly, the price of gold almost immediately negatively correlates to consumer confidence. So in other words, when consumer confidence falls significantly, the value of gold almost always goes up. Now, humans, as a general rule, have a hard time forgetting the bad times. They have a hard time dismissing their fears about things like the economy. So then, inevitably, the pattern continues. For a period of several months or maybe a couple of years, depending on how bad the economy got, the fear tends to stick around. And eventually, consumer confidence starts to increase. But that little voice in the back of people's head doesn't go away. The fear of another big 2008 or another pandemic, which leads for a period of, like I said, maybe a couple of months or a couple of years, gold prices continuing to go up in value. But eventually, consumer confidence gets back to the point where people start to feel comfortable with the economy again and don't feel as much of a need to actually hold gold as an asset, or at least not to buy more of it if they've already bought it. And this inevitably, almost all the time, leads to gold prices returning back to closer to where they were prior to the major loss in consumer confidence. And this pattern repeats itself over and over and over again. You see a massive loss in consumer confidence due to a major collapse, perhaps a financial crisis. And then you see gold continue to run up, maybe for a couple of years until consumer confidence gets to an all-time high again. And then that's when you see the price of gold come down. So while everyone in a period of time after a major financial crisis might be sitting there going, buy gold because you need it, it protects you against inflation, the reality is gold is less correlated to inflation than it is to fear in the market. And if you're smart about this, you can start to see the patterns emerge and prevent yourself from buying things like gold at an all-time high when there's a frenzy, which, like I said, is usually just after a major financial crisis when people are still fearful, even though the economy is getting better. And that's why, at least in my opinion, I believe it's so important to fix the percentage of gold in your portfolio. And when it starts to get above that percentage that you fixed it at, let's say 5%, you start selling because that's usually an indication that it's hitting those highs. And then eventually, if the prices go down, you start buying more to bring the percentage back up to 5%, and you're just constantly buying when it's cheap and selling when it's expensive. But if you were to take all of your assets because you believe that everything's going to hell in a handbasket and put it in gold, well, guess what? Gold is not a safe investment. It's just like every other investment, and you will be susceptible to major declines in the values. And gold, much like other assets, when it goes down significantly in value, it takes a long time for it to recover. So let's talk about what sets up a financial crisis. And let's start with the Roaring '20s. The economy was booming. Everyone was doing well. Everyone also started to believe that stocks could only go up in value, and it led to a credit-fueled economic boom. There was massive consumer demand for homes and cars. People were buying everything that they possibly could and often buying it on credit because they believed that the economy could only get better. But beneath the surface, there was a storm brewing. And the margin trading that existed at the time, which was essentially borrowing money to buy stocks, was what created the massive amount of risk that led to the Great Depression. And this was largely because the values of stocks got completely detached from reality. It was all buy without understanding the value of the investments. And this led to a massive bubble that was ready to burst in 1929. And the difference between this being just a run-of-the-mill recession and a complete financial meltdown was the fact that the bubble was ready to burst, but so many of the stocks that were being bought on the market were being bought with margin, which meant that when the bubble did in fact burst, the people who had bought them would not have the money or the assets available to make payment on the money that they owed. And that's what led to a massive shockwave through the economy that didn't just isolate itself to the US, but went completely global. This, in fact, was a financial meltdown. Then there was the 2008 housing bubble, which was essentially history repeating itself. Now, the memories of the 1929 crash led people to be less inclined to borrow a bunch of money to buy stocks. They'd already seen that program, they didn't want to go down that road. But hey, housing was different. People need a place to live, it can only go up in value. But it was essentially the exact same pattern that happened in the 1920s with stocks. And this debt-fueled buying frenzy of an asset that could only go up in value led to, well, one of the biggest financial collapses in history. Although it wasn't quite as bad as the Great Depression, the primary reason why was because we had seen that program before, and the government knew that if it didn't step in, it would absolutely get as bad as the Great Depression. So they stepped in and did what they could to save the economy, and while the damage was bad, it was a lot less worse than it could have been. But once again, this debt-fueled buying frenzy led to not just an American crash, but a global economic downturn. And again, that's the difference between a financial crisis and a run-of-the-mill recession. It's the debt that leads to the meltdown. And I hope you're sensing a theme here. Because when we do get the part where I explain how to protect yourself from a financial crisis, it's going to be a part of it. But it's just a small part of it. Now, let's talk about how financial bubbles burst. The signs were clear, at least in hindsight. Buying stocks on margin set up the storm. Buying anything on margin or with debt sets up the storm. And when the market opened on Black Tuesday, the sell orders came in, but there were no buyers present to actually buy the things that everyone wanted to sell. Then there was the housing market crash of 2008, and again, the signs of trouble were clear, at least in hindsight. Risky lending, things like ninja loans, no income, no job, no assets, created a financial storm. And this ultimately put 250,000 homes at risk, increased delinquencies by 667%, and triggered the worst recession we had seen since, well, the Great Depression. But even though the signs were so clear, nobody did anything to prevent it, which is a clear indication that it's up to you and I to protect ourselves, because nobody else is going to protect us from the inevitable when it happens. But if we get smart about this and we understand that historical cycles repeat, we can eventually educate ourselves on what to look out for and how to make sure that we're not in a position that when a financial crisis happens, we are taken to the cleaners. So if I haven't made it clear enough at this point, speculation fuels the crash, debt turns it into a financial crisis, and too much risk and not enough oversight is what turns a run-of-the-mill recession into a financial nightmare. So then the question becomes, can we predict the next financial crisis? Well, probably not, but there will be warning signs. Things like Bitcoin going to the moon with there actually being no value for Bitcoin other than the fact that there might be another guy down the road who's going to buy it. Now, I'm not going to say that you shouldn't own Bitcoin. I definitely think that there's some validity in having a very small portion of your portfolio in any asset that is perhaps popular. But you need to make sure that you're only keeping a small portion of your portfolio in that, not your entire life savings, and definitely don't be borrowing money to buy Bitcoin. If you have even a little bit of debt, you shouldn't be buying a speculative asset. And the same thing goes for gold as well. Now, as of right now, as of today, as of the time that I'm filming this video, it doesn't seem like we're setting ourselves up for a financial crisis because the level of borrowing that happened in the 1920s and prior to 2008 hasn't really been happening. Yes, there are some speculative bubbles in different types of investments that seem to be brewing, but a complete financial meltdown, at least right now, doesn't seem to be in the cards. But one thing to watch out for is that in today's day and age, where information spreads almost instantly, we're starting to see cycles speed up. So it may not be another 80 or 90 years until we see another major financial crisis, which means that today, now, is the time to start preparing so that you have the assets and you eliminate the risk in your personal financial situation just in case it does happen a lot faster than expected. So even though there isn't as much risky behavior happening right now, there's still definitely risky behavior. And let's be clear here, bubbles are driven by risky behavior. Taking everything you have and putting it into one type of investment. Buying things that really inherently don't have any value or don't produce any income. Things like Bitcoin and gold. Or even having a massive amount of debt and just assuming that your income is always going to increase and that you'll be able to pay it off later. And it's important to watch out for when the value of assets completely disconnects from reality. For example, there's a real estate company right now in North America that has a valuation bigger than the biggest real estate company in the world, which is Remax. The value of that company is completely disconnected from reality. So when all of my buddies keep saying, hey, you got to buy this stock because it's going to the moon, well, it's pretty clear to see that there's a buying frenzy and that the value, the price of that stock doesn't really match what they have in assets or even in potential earnings. So it becomes really clear that the FOMO and the herd mentality is the thing that you have to watch out for and avoid at all costs. Now, if you can get into something that's going to go up in value early and get out quickly, and you're only risking a very small portion of your portfolio, fine. If you want to do a little bit of gambling with your money, as long as it's a very small portion of your money, do it. But don't start following the herd and putting all of your assets into those risky investments. In other words, just don't follow the stupid people. Because bubbles are simply this, they're illusions. They're hard to predict, but they're highly visible. And once the panic sets in, the market collapses. It always does. So in the case of the stock I was just talking about, or things like GameStop, where you could have gotten in and gotten out real quick and made a small amount of money, maybe 10 or 15% on your investment, fine. But make sure you're not holding the ball when the panic sets in. Because once it sets in, the damage is already done, and there's nothing you can do to undo it. In fact, some of the best investors I know in the world, they will find the bubbles, they will buy in, they will take a 10 to 15% increase on their money in a very short period of time, but their goal is to just make a little bit of a lift and get out as fast as possible. And the reason why is because the cycle of bubbles is clear. It always repeats. They follow a predictable pattern. And in order to minimize the damage, especially leading up to a financial crisis, there's two things that you can do. And they're the only two things that you really need to do. Always make sure your investments are diversified into a diversified portfolio. I highly recommend that you go and take a look at Ray Dalio's all-weather portfolio and forget what everyone's saying about it not performing in the last 10 years. It'll perform over the long run. And if you make sure that you're in a portfolio that's set up like that, you run very little risk of seeing a massive hit on your investments. And then the next step is to make sure that you're never buying anything on credit, with perhaps the exception of a home, with the goal to pay that home off as fast as humanly possible. Because like I said previously, it is the speculation that leads to a bubble. It is the debt that turns it into a financial meltdown. And if you don't have the debt, you reduce your risk to almost zero. But if you do have the debt, well, guess what? You're going to get wiped out with everybody else. So recognizing FOMO and having the ability to avoid risky behaviors is paramount. Like I said, investments like Bitcoin and gold are not immune, and most people always find themselves falling for the sure thing that turns out to be not so sure. But here's your secret weapon. Your secret weapon is exactly what you're doing right now. It is educating yourself. Financial literacy is the best defense. And it's my belief that everybody should be spending at least 10 to 15 minutes a day trying to increase their financial literacy. And I don't mean watching YouTube videos about how the sky is falling and how everything's going to hell in a handbasket. I mean reading the classics, the books like Think and Grow Rich, or pretty much anything written on how Warren Buffett invests, and learn how real investors are able to invest and avoid the very, very, very bad things that happen during a financial crisis. And also understand that knowing history gives you an edge. Yesterday's tulips could be today's gold or tomorrow's Bitcoin. Because at the end of the day, the next crisis isn't a question of if, but when. And history gives us clues, but we must act. And the way that we act is by preparing for the inevitable long before it ever happens. And in order to do that, it all comes down to financial education. That is what protects you from becoming a victim. And this all sums up into this. Spot the signs, don't follow risky trends, act on the lessons of the past, and stay ahead of the next financial crisis. Financial literacy is your shield. History repeats, be prepared, and act on this knowledge that you gain in order to avoid disaster. Throughout history, mighty empires have risen to unparalleled heights, only to crumble into the dust of forgotten eras. From the grandeur of Rome to the economic might of the 20th century superpowers, the story is always the same. But what causes these collapses? What are the warning signs that can transform prosperity into precarity? And what does the US need to watch out for? Today we are at a crossroads. The economic landscape is shifting under our feet, and the patterns we see now mirror those that have preceded the downfall of the greatest empires in history. This is what always happens before an empire collapses. Are you paying attention? It's no secret that the United States is at a crossroads. As countries de-dollarize and many countries choose to team up against what is the largest and greatest nation, arguably, in the world, we are seeing more and more fear, especially here at home. Will the dollar collapse? Is the economy about to collapse? Do we have a debt problem? And just how bad is it? And even more importantly, just how long does the US have to continue to be the primary world superpower? And in this video, I'm going to discuss the rise and the fall of many of the great empires, what is consistent among all of those collapses, and where exactly the US is right now, especially relative to China. And then at the end of this video, I'm going to discuss what you can do to protect yourself from the inevitable, because every great empire in history has collapsed, so that you don't have to worry about your finances when that happens. But before we get into that, let me tell you about our sponsor for this video, Surfshark. If you're watching this, you likely make the odd investment trade online, and at the very least, you almost definitely have online banking. But you probably haven't thought about how important it is to protect your account information, especially when you're using public Wi-Fi. Surfshark offers privacy and security solutions to safeguard your data and privacy online. It encrypts your internet traffic and masks your IP, your internet protocol address. It can help you protect yourself when using public Wi-Fi in coffee shops, conference rooms, airports, and especially in hotels. Once your device connects to the internet, all your information is encrypted. And not only does it protect you, but you can also watch your favorite streaming services when you're in a different country, or use it like I do to see how news stories are being portrayed in other countries. Because quite often, the news stories that we get here at home are significantly different in other countries, even though they're covering the exact same story. And I can't emphasize how important this is, both from a security perspective and from the perspective of knowing what's really going on in the world. And one of the best things about Surfshark is it can be used on multiple devices, and it comes with a 30-day money-back guarantee. So you can take your time to try out the service and experience the whole Surfshark VPN potential. If you use public Wi-Fi and you aren't protecting your email, your internet browsing, and your banking information, you're taking a massive risk. And if you want to try it out, don't forget about that money-back guarantee. Go to surfshark.com/Nolan or use code Nolan at checkout to get an extra 4 months of Surfshark VPN. So I'd like to begin by talking about the most recent changes to the New World Order. And full credit where credit is due here, many of the charts in this video come directly from Ray Dalio, and specifically from his book, The Changing World Order. And whether you want to delve into the full book or not, you can simply search Ray Dalio, The Changing World Order, and LinkedIn, and Ray Dalio has posted summaries of each chapter. Now, that being said, many of the charts in this video do come from Ray Dalio's book. However, a lot of the research has been done outside of that book. Research that I've done on my own using scholarly journals, encyclopedias, and I have come to many of my own conclusions, which in a lot of ways mirror Ray Dalio's opinions, but in a lot of ways don't. And there's one specific difference between Ray Dalio's thought process and mine, which I think is quite interesting. Now, that being said, Ray Dalio is incredibly more successful than I am. He is one of the leading thinkers in the world right now, especially when it comes to economic collapses. But I do think that even with the best thinkers in the world, there is always a need for context and simplification. And that's what I intend to do in this video, is try to simplify a very, very complex topic. Over the last several hundred years, we have seen the Netherlands be the #1 superpower in the world, to be taken out essentially by the United Kingdom, and then the United States taking over just after World War II as the primary world superpower. And a lot of this has to do with several things, including military power, economic power, GDP, and most importantly, the status as the world's reserve currency. And as you can see from Ray Dalio's chart here, China is very much on the rise, while the United States is facing, at this moment right now, a decline. Now, in my research, I was able to determine that there are essentially 5 reasons why superpowers collapse. Now, there's all kinds of articles out there. There's articles that say there's 7 reasons or 12 reasons or 15 reasons. But what I did is I took a look at the most recent superpower collapses, and then I compared them to one of the most famous and the most horrific empire collapses, which was that of ancient Rome. And when you go back in history, you can see that there are things that continually happen time and time. And what I found was that there was 5 commonalities between the recent collapses of world superpowers and that of ancient Rome. And they were primarily economic decline, military overreach, political instability and corruption, internal strife and rebellions, and external pressures. And primarily external pressures means pressures from other countries. Now, Dalio has this chart where he talks about the typical big cycle behind empires, rises, and declines. And as you can see, there's always a new world order, and then there's peace, prosperity, and productive debt growth, and then eventually a debt bubble and a big wealth gap. Is this starting to sound familiar? And then eventually there is a debt bust and an economic downturn. This would be the equivalent of what happened in 2008 and the financial crisis. And after that, countries tend to begin printing money and credit, which leads to eventually revolutions and wars as their power financially starts to decrease. And after that, you start to see debt and political restructuring. And once we hit that point, which is typically after a war, by the way, you start to see a new world order emerge. Now, that doesn't mean that the previous superpower completely collapses, because as you are well aware, the United Kingdom still exists, as does the Netherlands. But what it does mean is that a new power rises to dominance. And in this case, it is starting to become apparent that China has a very good likelihood of once again being that superpower. Because in the past, China has in fact been the primary world superpower. And I'll show you a little bit more on that a little bit later. But I want to provide some context here first by taking a look at ancient Rome. The Roman Empire had these same 5 things that happened. They had overexpansion and military spending that led to severe financial strain within the empire. And that eventually led to heavy taxation. And that subsequently led to inflation, and that weakened the entire economy. And lastly, the reliance on slave labor, which was very much upended by several major wars, which led to a lot of deaths within the empire, including that of many of the slaves, stifled innovation, and hampered economic mobility. So in other words, without the workers that were so necessary to keep the economy going, the economy essentially imploded. Now, in addition to that, there was significant military outreach and defeats. There were continuous military campaigns that drained resources. Ancient Rome was obviously an empire that sought to expand its reach, but that only could last so long. And eventually, as the Roman Empire started to show its weaknesses, there were invasions by barbarian tribes, and essentially that led to a reduction in resources that pretty much stifled the Roman Empire to a place where it could no longer succeed. Now, with those invasions came frequent changes in leadership and civil wars. There was infighting. And as more and more leaders tried to take the helm, that led to corruption, and that eroded the trust in the leadership. Is this starting to sound familiar? And this all eventually led to the splitting of the empire into eastern and western halves, with the west falling in 476 AD. So essentially you had a once great empire that was split in 2. Now, this was very much physically, but if you look at what's happening in the United States right now, where the country is very much being split from an ideological perspective, it starts to become apparent that there are certain lessons we can learn from the Roman Empire. But here's the major one. Social and economic inequality led to internal conflicts. The rich got richer, the poor got poorer, and that led essentially to civil unrest. And it was the rebellions and the power struggles among the different factions that ultimately led to a place where the empire just could no longer continue. So as you can see, there's some clear parallels between the current day United States and the Roman Empire. And this is important. You need to be paying attention to this because it is clear that if things get worse, and by the way, all of this stuff can absolutely turn itself around. But if things get worse, well, we could find ourselves in a situation where China really does become the new world superpower. So returning to our reasons why superpowers collapse, Ray Dalio has a great chart here that shows the relative standing of great empires. And this goes back to the early 1500s. And essentially what you can see is that there's always, as one superpower, like the Netherlands, the yellow line, is declining, there's always another one on the rise. And as the United Kingdom started to decline, the United States was on the rise. And now it seems as the United States is declining, China is on the rise, which makes it somewhat likely that they could be the next world superpower, except there's one major thing, which I'll get to a little bit later on, which could potentially prevent them from taking the United States out completely as the primary world superpower. But before we get to that, I want to point out that there are certain things that happen early in an empire's rise and certain things that happen early in an empire's decline. And I'm going to point out right now that the black line, which is the reserve status, is typically the last thing that starts to decline. And it tends to happen very late in the cycle, almost 20 years after the start of the decline of pretty much all of the other factors. But if you look at the first two things that almost always start the rise of an empire, it's almost always education and innovation and technology. Think about the US taking over from Great Britain as the world superpower. It was very much the creation of the atomic bomb, the innovation and the technology associated with nuclear power that led them to become the new world superpower. Now, from an education and an innovation and technology perspective, it's quite clear that China is also on the rise. But the question is there a decline in the US's education and innovation and technology? And if you look at the world of what's happening with AI right now, it's hard to argue that the US's impact on innovation and technology isn't still on the rise. And on the same note, if you take a look at things like the military, trade, economic output, these things all seem to be also continually on the rise in the United States. It doesn't seem like we've hit that inflection point where we are quite on the decline yet. Now, is there some question about whether the status as a reserve currency is on the line? Yes, there are many countries that would like to see the US dollar abandoned. And is there an argument to be made that we are no longer the primary financial center? Well, we're still the financial center of the world. However, there are countries that are trying to knock the US off of that perch. But even though Ray Dalio suggests that we are beginning the decline, and it's clear that we've probably hit a peak, my guess is that we're somewhere near the peak of the US empire. And if we reference Ray Dalio's assertion that the rise and fall of an empire lasts about as long as a human life cycle, well, that would imply that we're about in the middle, and there's potentially anywhere from 20 to 40 to 60 years until the US really has to worry about being knocked off that perch. Now, that being said, the US is definitely 80 years into being the world's leading economic power. The question is, how much longer does the US have? And the answer to that question is very much hard to figure out. But if you watch YouTube videos and you read certain articles online, you might be led to believe that the end is very much near. And the reality is it probably isn't. Yes, there's more competition, but that competition still has a long way to go to supersede the US as the primary world superpower. So let's take a look at the 5 things that lead to the collapse of a superpower. And let's start with economic decline. And what I'm going to do here is I'm going to explain each, and then I'm going to reference those to the Netherlands and the UK. And then after that, at the end, I'm going to show you exactly what's going on in the US, the decline of the US, and the rise of China. And I'm going to show you that one thing that could potentially cause the US to maintain its superpower status. Economic declines in superpowers and empire collapses almost always comes down to 3 things: excessive debt and financial mismanagement, loss of competitive advantage and economic stagnation, and rising inequality and social unrest, which is, by the way, about where we are right now. There is, in fact, rising inequality and social unrest in the United States. And when you look at the United Kingdom as an example of this, there were significant things that led to economic decline, things like costly wars such as the World Wars that drained financial resources. There was the loss of colonies that reduced the economic power and the influence of the United Kingdom. And there was industrial decline in the mid-20th century as other nations industrialized, including the United States. Then if you take a look at the Netherlands prior to that, there was the over-reliance on trade and naval dominance, the economic competition from emerging powers like England and France, and the high cost of maintaining a vast trading empire. So in other words, when you have a whole bunch of countries that you're trying to control and trade with, it becomes very, very expensive to defend those relationships, both through diplomacy and through military. And that leads us to the second thing that typically causes empire collapse. and that's military overreach. Prolonging costly wars that drain resources, and the overextension of military commitments. Starting to sound familiar? I hope you're paying attention here. So let's take a look at that from the perspective of the United Kingdom. There was obviously the involvement in 2 world wars that weakened the military and the economic strength, and as previously mentioned, the withdrawal from colonies and loss of geopolitical influence. And then in the Netherlands, there was the wars with England and France, particularly the Anglo-Dutch Wars. And I cannot emphasize enough that there was an extended period of war prior to the United Kingdom succeeding the Netherlands, and it was primarily these wars and the loss of the naval supremacy that led to the loss of key territories, and that subsequently led to a shrink in trade and a shrink in the economies. They were no longer the vast superpower from a military perspective, and as a result, that had a significant impact on their economy. And for comparison, if you look at what happened to Germany during World War II, you can see that similar things have happened over time. When you lose a war, you tend to lose a lot of your economic viability, you tend to owe the winning parties a lot of money, and as a result, you tend to go through a significant period of time where you just don't have the economic power to compete anymore. And often the loss of that economic power leads to political instability and corruption. There's almost always deep political divisions and ineffective governance. Welcome to the United States in 2024. And there's almost always an erosion of trust in institutions and leadership. And if you look at what is happening in the United States right now, there is very much a 50-50 split between one party and the other, and members of both parties simply do not trust one another. This is where things start to get scary. And if you look at the United Kingdom, there was the post-war political instability and frequent changes in government as governments were unable to rebuild what they had lost during World War II. And there was challenges in managing a large empire and addressing domestic issues. If you have issues at home in the United Kingdom, it becomes almost impossible to affect places like Canada and Australia and all of these pieces of the empire that are spread out throughout the world. And similar sorts of things in the Netherlands. The collapse of the economy led to internal political divisions and conflicts as the poor got poorer and the rich got richer. That led to a divisiveness, and that led to challenges, once again, in maintaining control over a diverse and widespread empire. Now, for context here, the United States has never really had an empire in the same way that the United Kingdom and the Netherlands had. However, if you look at it from an economic standpoint, they very much do have an empire based on all of the countries around the world that rely on them both for their military might and their economics. So while the US empire isn't so much an empire that is built on the amount of land that they have control of, it is very much an empire built on the amount of influence that they have. And that influence is starting to wane, as we know from the Saudi Arabia abandoning of the petrodollar, which, by the way, was fake news, but there's very much a desire of Saudi Arabia to look at joining the BRICS nations, which means that the US is potentially losing a lot of that influence. And of course, once you have political instability, you start to have internal strife and rebellions. It could be argued that January 6th was indeed an internal rebellion. And that's largely due to social and economic inequality, which leads to the internal conflicts. And then there's, of course, the power struggles and the factionalism within the state. This is the power struggle that the Democrats and the Republicans are facing right now. So when we put that in the context of the United Kingdom, you had the decolonization movements and independence struggles in colonies. You had the social and economic challenges within the UK, such as the miners' strikes in the 1980s, which led to significant economic pain. And then in the Netherlands, you had economic and social challenges that led to internal conflicts because wars, loss of superpower status, all of that stuff. And you had the resistance and the rebellions in the colonies. Because when you're a colony of a great empire and you start to see that they are weak, you start to see an opportunity to rid yourself of their control, which is pretty much what the US did with the United Kingdom in the 1700s. And then all of this leads, when the weakness is clear, to external pressures and invasions. You get competition from rising powers like the US is facing from China right now, and you also potentially get external invasion pressures. Now, in today's day and age, due to mutual deterrence from nuclear weapons, the external invasions and pressures potential isn't quite as high as it was in the past. But it is still, in fact, something that we need to watch out for, because there are other types of external pressures. Think about it from the Russian perspective right now, where the US cut off their ability to trade in US dollars, which was essentially economic warfare as opposed to military warfare. And when we put this into the context of the United Kingdom, the rise of the United States and the Soviet Union as superpowers obviously led to significant external pressures. Now, this rise of the Soviet Union was largely due to their vast military might, not so much their economic might, but it was a significant external pressure. And in addition to that, there was also competition from emerging economies as countries like China started to industrialize and started to take a significant portion of the trade that once was originated in the United Kingdom. And then with respect to the Netherlands, there was obviously the competition from other European powers, particularly the UK and France. When the UK and the Netherlands got into their war, France took the opportunity to kind of backdoor and pull up a lot of the Netherlands trading relationships. And there was, of course, the loss of colonies to rival powers. Because if the UK and the Netherlands are at war, if you're another country, why wouldn't you go and try to steal a bunch of their colonies while the other two powers are fighting? Now, this is where it becomes interesting because this is where we need to discuss the decline of the US. And right now, the US is definitely facing these 5 factors that lead to an empire collapse. From an economic decline perspective, the debt and the deficits are of particular concern. Now, relative to other countries, including China, things aren't quite as bad as you might expect, but they are significantly worse than they have been for the United States in the past. From a political instability perspective, we're seeing polarization and erosion of trust in the government. From a military overreach perspective, we're seeing costly wars that continue and global military commitments that are just so significant that they're one of the leading factors that is leading to the debt and the deficits the US continues to run up. And of course, we have the social decline. This is the rich getting richer, the poor getting poorer, and that is very much apparent after the pandemic. And as all of these things start to come into play, there are external pressures, rising competitors, the BRICS nations, technological disruption, and a real serious threat to places like Taiwan that the US relies on to feed their technological innovation, which if there were a conflict between China and the US with respect to Taiwan, that could very much lead to a significant decline in the US's ability to be technologically competitive. Now, on the other hand, with respect to the rise of China, we're seeing rapid industrialization, infrastructure development, innovation, and technology. From a political stability standpoint, we're seeing centralized authority, economic reforms. The military is consistently expanding. The social cohesion is getting better and better. Education is improving, health is improving, and there is global integration, both with the BRICS nations and with many of the other nations all over the world. But that also includes the significant relationship between China and the US, which includes the US being the biggest buyer of Chinese goods and China being the biggest supplier of US goods. Now, there's one theme that has been consistent when we've talked about the Roman Empire, the Netherlands, and the UK, and that is that the collapse of all of those empires was largely due to a significant war. And it's my opinion that the prospects of war is the one thing that could see the United States and China actually not interchange with respect to their superpower status, but very much run in parallel for a significant period of time. Because there's a whole bunch of things that make war between the US and China less likely than a war between countries like the Netherlands and the UK. There is the diplomatic engagement and communication, the instant communication between nations that never existed before. Then there's also the economic interdependence, the fact that China relies on the US as much as the US relies on China. Now, clearly with the BRICS nations, they are trying to do everything they can to make it so the US can't dominate who a country can trade with. But that doesn't mean that if, in fact, the BRICS nations are able to come up with an alternative reserve currency, that it will definitely take out the US dollar as the primary reserve currency. In fact, there's a lot of good evidence to show that there could be multiple reserve currencies in the future. And I'll link to a video about that at the end. But the big one, and the most important one, is the military deterrence and balance. You have 2 superpowers, both have nuclear weapons, and unlike in the past where an invasion or a fight or a war could have been devastating but not catastrophic, a war between 2 superpowers in today's day and age would in fact be catastrophic to not just one, but both economies. And we're not talking about a significant portion of a population being wiped out. We're in fact talking about the majority of a population being wiped out, which is why the US and China are likely not going to go to war anytime soon. which is important to understand because those 5 economic factors always included wars. And in this case, it's highly unlikely that there will be a war that will cause a new world order in the way in which it has in the past. So without that one thing that essentially leads to those empires collapsing and puts the nail in the coffin, my observation is that we might see 2 countries, the US and China, run in parallel for a significant amount of time as dual world powers as opposed to there only being one. And that would very much be in line with the global economic theories, which is essentially that the world has become so interconnected that we're very much acting as one giant unit as opposed to many individual ones like we have in the past. And particularly when I say one giant unit, what I mean is one giant economic unit. And the evidence of this, the fact that this is highly likely to be true, is the fact that during the pandemic and during the financial crisis, when we saw one economy struggle, we essentially saw all of the economies struggle. And that was largely due to the interconnectedness of all of the economies in the world. Now, all that being said, that doesn't mean we shouldn't be cognizant of what's happening from a global perspective, because there is in fact the possibility that the US could no longer be the world's leading superpower. The question is, what do we do to protect ourselves in the event that this comes to fruition? And the reality is, it all comes down to your investing strategy. It all comes down to the things you own, where you own them, and what you do if the worst comes to worst. Now, it's my belief that somebody shouldn't be taking their money and investing it outside of the US and doing all of these things immediately. But it is my belief that you need to watch what's going on with the global economy. And as things start to show signs of weaknesses and there seems to be cracks in the armor of the United States, it becomes very clear that you need to start thinking about how you can protect yourself. So the question is, what can you do to protect yourself? Well, the first is, as things start to seem like they are becoming more and more dire for the United States, you want to start diversifying investments internationally. And not only diversifying internationally, but across asset classes, which means you don't want to just own energy and you don't want to just own automotive manufacturers. You want to try to own the equivalent of the S&P 500 in another country. Now, this is only if things get really, really bad. Yes, right now it makes sense to put a small portion of your investments into other economies, but as of right now, the US is still very much the best place in the world to invest. This is the what-if scenario for if the worst case starts to happen. And you want to invest in international markets, foreign stocks, foreign bonds, foreign mutual funds, and consider international real estate and commodities. And in order to do this, you can use global exchange traded funds to gain exposure to different markets. And that is a very easy way to expose yourself to those global markets without having to worry about foreign currency exchanges and setting up accounts in other stock markets that you may not have really accessible to you. In addition to that, if it starts to seem likely that there's going to be hyperinflation, and keep in mind that 8%, 10%, 50% isn't hyperinflation. Hyperinflation is when currencies are decreasing in value by 50 to 100% in a day or a month. But if it does seem like there's going to be hyperinflation, you want to start holding assets in more stable currencies. So the first thing you do if there's going to be hyperinflation, and it seems like that is what's happening, is you start to convert as much cash as you can to more stable currencies. So other currencies, for example, could be things like the Swiss franc, the Japanese yen, or Bitcoin. Although there's an argument to be made for how stable Bitcoin actually is, as you see the big swipes up and down on a daily basis as investors start to either feel really good or not so good about that cryptocurrency. And you want to consider holding assets in currencies of countries with strong economic fundamentals. So if the US seems like it's going to hell in a handbasket, look to places like Great Britain, look to places like Canada, look to places like Japan, look to other countries that seem to have those strong economic fundamentals and invest there. In addition to that, you can consider investing in safe haven assets. Now, yes, I'm the guy who made the video about why you shouldn't buy physical gold and silver. And we're definitely not at the point where the US is so close to collapse that you need to start converting your cash into physical gold and silver and deal with all the premiums associated with all of that. You want to have a little bit at home to set aside just in case, fine. But don't start converting all your US dollars into gold and silver because, well, you're going to get burned by the gold dealers who love to sell it to you at a higher price than what it's worth and buy it back for significantly less than what it's actually worth. In fact, I kid you not, physical gold and silver dealers are very much the equivalent of used car dealers. But you can expose yourself, and I do believe in exposing yourself and your portfolio to precious metals and things like ETFs to the tune of about 5 to 10%. And you can also consider government bonds from other countries as well. But one of the absolute best investments I think somebody can make is real estate in an economically stable regions that can also be a safe haven investment. But the key here is that they need to be debt-free. So if in the event that you can't pay the debt, you don't lose the properties. And this is, in my mind, the most important one. You want to stay liquid. You want to be able to respond quickly to changing economic conditions, take advantage of new opportunities, and you want to create a safety net during financial emergencies. So you want to keep a portion of your portfolio in cash or cash equivalents and ensure easy access to funds without significant penalties. And the last thing I would be doing right now or at any time is giving my money to somebody and having it locked up for 5 or 10 or 15 years. Because in the last 15 years, we've seen too many crises. And to have your money inaccessible is just something that I don't think anybody should be doing. So stocks, bonds, ETFs, great investments, but locking your money up in things like land investments where you don't have control of the land is just not something that I think is prudent. And last but not least, it is completely and 100% your responsibility to focus on financial education and skill development. This is the one thing in life where you're responsible for both educating yourself, you never had a teacher there to do this, and also being completely and 100% responsible for the amount of knowledge you have and subsequently the results that you get. And you want to stay informed about global economic trends and financial markets and continually be educating yourself about investing, economics, and financial planning. But most importantly, you need to be going to reputable sources for this information. Don't just watch that guy on YouTube who's telling you to buy gold or telling you not to buy gold. Don't just go and listen to that financial YouTuber because, you like that he's got a nice haircut and a Ferrari. Go and find real, actionable information from real experts and make sure you stay up to date. And when you're staying up to date, make sure the financial news sources and the analysis that you're getting is in fact from a reliable source. Because I'll tell you right now, one of my favorite YouTubers, one of my favorite financial YouTubers, about a month ago, made a video about Saudi Arabia abandoning the petrodollar. And the irony is, the petrodollar, in the way that he described it, never actually existed. So it's important that not only do you know where you're getting your information from, but that you personally fact check that information. Don't just take that guy on YouTube's word for it. Go look for the information, find it for yourself, find reliable sources that back up what was said. And if you can't prove it as fact, it's probably fiction. What you're about to see might keep you up tonight, because what I'm about to share isn't your typical doom and gloom economic forecast. This is the real deal, backed by cold, hard facts that'll make your jaw drop. You see, every single depression in history has followed the exact same pattern. It's like watching a tragic movie where you know the ending, but nobody else does. And here's the kicker. Right now, we're seeing all the classic warning signs flashing red. Skyrocketing markets that make everyone feel like a genius, debt levels that would make your grandmother faint, a wealth gap that's turning into a wealth canyon, and the scariest part, nobody's paying attention. But here's where it gets interesting. Well, most folks are out busy playing musical chairs with their 401ks. A small group of smart money players are quietly positioning themselves for what's coming. And today, I'm pulling back the curtain on their playbook. We're going to talk about the difference between a recession and a depression, something that the last few generations haven't seen. The 5 unmistakable signals that always show up before an economic collapse, why traditional safe havens might be the riskiest place for your money, and most importantly, how to turn this looming crisis into your biggest opportunity. So don't wait until the mainstream media starts ringing the alarm bells. By then, it'll be too late. Now's the time to start preparing so you can be part of the smart money instead of part of the group that gets wiped out. So let's start with the obvious here real quick. The first thing about a recession or depression is typically nobody sees it coming. No matter what anybody tells you, these aren't things that are widely predictable. There are always surprises that save the economy from a recession, like in the last couple of years. And there's always surprises that nobody sees coming that lead to major financial economic crises, like what happened in 2008. And while everyone thinks they'll see it coming, they never do. Every depression, every recession follows the same warning signs. And today I want to show you how to spot them and prepare. knowing that you aren't going to be able to predict them perfectly, but that if you pay attention to what's going on, you can protect yourself just in case they do happen. And the first thing that we need to consider is that there is a very real difference between a recession and a depression. If you watch places like this, YouTube, where you have all kinds of people who now have a voice and an ability to talk about things like recessions, depressions, and the economy, you'll know that many people believe that the next depression is right around the corner. And myself included, I now have a voice. I have an ability to talk about the things I want to talk about and get millions of views. But my purpose is to make sure that the things that are out there that are scary aren't driving your financial decisions, but at the same time to make sure you're prepared in case the inevitable does eventually happen. And the main thing to understand here is that both a recession and a depression involve economic decline, but one is far worse than the other. So let's talk about the differences. First, there's duration and severity. Recessions last a few months, maybe a couple of years. Depressions, on the other hand, can last several years or even a decade. They are significantly longer in nature than your typical recession. Then there's the GDP decline. Recessions, GDP declines for 2 consecutive quarters. Now, a decline, technically speaking, can be 0.1% or 0.01%. And it's only for half a year to qualify as a recession. A depression, on the other hand, can see GDP drop by 10% plus and remain low for years. It's a far more severe and deeper economic collapse. In fact, even 2008, which I'll talk about later, wasn't really a depression. It was a very severe recession, but nothing like what the people went through in the 1930s. Then there's employment rates. During recessions, unemployment rises to 5 to 10%, quickly recovers. Depressions, on the other hand, can see unemployment hit 25% or even higher, and those job losses in a depression can be severe and long-lasting. Normally during a recession, people will lose a job and typically get rehired somewhere else within 6 months to a year at worst. During a depression, the ability to get a new job can often take years. Then there's things like business and bank failures. During a recession, you might have some businesses fail, but most survive. But during a depression, there's widespread business and bank collapses. The financial system breaks down to the point where businesses, which are typically set up in a way where they can survive, don't. And then there's the stock market, because during a typical recession, you'll see a drop of 20 to 30%, and it'll recover in a few years. During times of depressions, markets can crash 50+% and take decades to recover. I mean, even think about the 2008 financial crisis. It only took a few years for the stock market to recover. It only took a few years for the housing market to recover. But when there's a depression, it can take decades. And not only that, during the Great Depression in the 1930s, stocks dropped almost 90%. They didn't get anywhere close to that during 2008, during the financial crisis. And when you really take a look at this, you have times like 2008 and 2020 where we saw severe recessions. And yes, they were severe, but they were nowhere near the magnitude of the Great Depression, which is why previous generations have been so afraid of things like debt and have been far more inclined to save money. It's because the Depression is the type of thing that strikes fear into people, unlike things like 2008 and COVID, where we saw spending decrease, we saw debt maybe not get accumulated as fast, but a few years later, we obviously started seeing people fall back into the exact same habits they had before. Otherwise, why would debt be at an all-time high like it is today? So before I get into the warning signs of how you can spot a depression coming, here's the bottom line. A recession is temporary. A depression is prolonged. And for most people, at this point in time, there are very few of us that have ever seen a depression. We only have these stories from our grandparents and our parents to remind us of the dangers. But it's important to understand the difference in order to prepare for the future, in order to make sure that if a depression does come around, we are positioned to not get wiped out by it. But before we talk about how to prepare, let's talk about those warning signs. Okay, so there's clear warning signs that a depression is on the horizon. How do we know this? Because we can look back in history, and in hindsight, it's very clear. Now, these things may not be as obvious in real time, but if we really pay attention to what's going on, we can look at present day compared to the past and at least know if we're at risk of something going bad. And the first sign that a depression is on the horizon is typically the illusion of prosperity. The economy appears to be booming like it was post-COVID, but there's weak foundations built off of things like money printing. Speculation runs rampant. There are people who are investing in things like Bitcoin and gold and believing that those investments cannot fail. but they can and they will. But the concept of easy money leads people to make financial decisions that had they ever actually been through a Great Depression, they would never make, because people ignore the warning signs. And there's always the belief that this time is different. We've got a new president, we've got some other financial thing that makes this time different. The reality is, it's probably not. The only question is, how bad will it be? Will it be recession bad, or will it be depression bad? Then there's warning sign number 2. Debt explodes. And yes, absolutely, we've seen this. We've seen it with the government's debt, we've seen this with business debt, and worse, we've seen it with individual debt. Debt that is completely unsustainable, and that's fueled by cheap credit that encourages risky financial behavior. Borrowing on credit cards, buying bigger houses that people can't afford if something happens in the economy. And the bigger the debt bubble, the harder the crash. We saw this in 2008 with the financial crisis. And by the way, we saw this during the Great Depression, leading up to the Great Depression, where everyone was borrowing cheap money to invest in the stock market, only to have the stock market fail and everyone be completely underwater. Now, the scary thing about today is that most people aren't borrowing money to invest. A lot of them are just borrowing money to consume, because wages, which I'll talk about in a second, haven't kept up with the amount that prices have increased. And lifestyle creep is causing people to borrow money in order to make sure that they can keep up with the Joneses. Then you've got warning sign number 3, and that's where the wealth gap widens. The rich are getting richer while the middle class stays stagnant. And we're seeing this very clearly. The rich are getting significantly richer. It wasn't long ago that the richest man in the world, Warren Buffett, only had $100 billion. And I say only, tongue-in-cheek. Now we see the richest man in the world has $400 billion, and Warren Buffett is barely on the radar of the top 10. And while asset prices are rising, the rich are definitely getting richer because they are the ones providing the things that people are spending money on. But the wages for the people who are being paid to make those goods, and wages pretty much across the board, are failing to keep up, which creates economic inequality that reaches extreme levels before a collapse. And the level of debt that's being carried by average folks is typically an indicator of just how extreme this inequality has become. Then you've got warning sign number 4, the trigger events. So a single event sets off the panic. A bank collapses, the stock market crashes, or there's a debt crisis. Or maybe there is some sort of chaos around the economy associated to things like, tariffs. And pretty much you see confidence disappear overnight. We're already seeing this in the stock market. We're seeing it plummet as people are concerned about the volatility. And subsequently, people rush to pull their money out. They do that rejigging of their 401k in order to protect themselves, only making the problem worse. And as panic spreads, the market plunges. But then, this is where it gets really bad. Warning sign number 5. Government reaction comes too late. Maybe because previously money printing was a problem. Or maybe government was seen as too big, or maybe they were blamed for many of the problems that happened in the last recession. And as a result, the central banks scramble to inject liquidity into the system. But maybe they don't do it as fast as needed because of the perceptions created in the past few recessions and the public opinion with respect to money printing. Then you start to see public trust in financial institutions erode as there's runs on the bank as banks fail. And by the time the help arrives, the damage is already done. It's too late. Now, luckily in 2008 and luckily in 2020, the government was able to interject in a reasonable period of time. The question is, will the public trust be there for the government to intervene in time the next time we find ourselves in a potentially catastrophic situation? But regardless of how fast the government steps in, if you are prepared, if you're set up to thrive, you won't be the victim of the next Great Depression. So let's talk about how to survive instead of just thrive. So here's the reality of a depression. Unemployment will spike, people will lose jobs, businesses will shut down, and people will lose their homes. But there are ways to protect yourself from any of this stuff happening to you. Consumer confidence, of course, will collapse, and there will be changes in spending habits for generations. I saw this with my parents saw this with their parents. It's clear that when a depression happens, people change, and their views on money change as well. But the world doesn't end. However, life does, in fact, change permanently for many. The question is, will it change negatively or positively for you? And this is where we need to consider the hidden opportunity. Whether the next recession is just a recession or a depression, every recession, every depression creates a massive wealth transfer opportunity. Assets go on sale at historic lows for those who are prepared, and the smartest investors, the ones who have prepared well in advance, are able to buy when everyone else is panicking. So how do you prepare and win? Well, you start by holding real assets like real estate, gold, and cash flowing businesses. Now, be careful here because you don't want to have all of your money in any one of these things, especially not in gold. But having a small percentage of your net worth in gold can definitely be beneficial during something like a depression. And I'm talking no more than 5 to 7%. Then you want to eliminate risky debt before it's too late. Get rid of any liabilities that could bring you down with the system. And then the next step is to build multiple streams of income that can survive an economic downturn. Now, this could be other types of employment, a business that you run, income from rental properties, or even dividends from investments. But it's important that your income doesn't all come from just one source. And there's 5 things it's important to understand when it comes to protecting yourself from the next big downturn. The first is that real assets are your shield. Paper wealth can collapse pretty much instantly, but real assets hold value. Things like real estate, gold, and income-producing businesses will in fact survive. But also note that cash can lose value very quickly, especially in periods of inflation that often come along with money printing that is designed to prevent the next big major depression. Then it's important that you understand that being debt-free is a significant advantage. High-interest loans, even mortgages, can crush people in downturns. So now, right now, while things seem to be good, is the time to clean up your finances because debt-free individuals fare better in crises. And especially debt-free individuals who own things like real estate without debt, they're the ones who are most likely to survive any economic storm. Then the third thing you need to know is that it's important to build resilient income streams. Diversified income helps weather economic shocks. Side businesses, rental income, or essential skills that you can sell and barter with are hugely valuable during times of economic need. The people with multiple streams of income are in fact the people that thrive during depressions. And I'll talk a little bit more about how to build multiple streams in a second. But the fourth thing you need to understand is learn market cycles. Every downturn creates buying opportunities. It's important to understand when things are getting frothy and be able to see that there's the potential for a major drop where you'll be able to purchase investments at bargain basement prices. But that doesn't mean you sell all of your investments. What it means is that you have a certain amount dedicated to cash that you can use to pounce when the time is right. Because like I said before, assets go on sale when panic strikes, and it's those people that have access to cash that are able to buy assets at a discount and ultimately build significant amounts of wealth. In fact, there's more wealth built during downturns than there is at any other time. And it's largely due to the fact that people can buy at a discount during those times. And then last but not least, it's important to develop skills that stay valuable. This is how you create multiple streams of income. So the question is, will your skills be in demand during a crisis? And if they aren't the type of thing that people will need during a crisis, then you need to go about developing skills that will make you indispensable to your employer or allow you to earn income outside of your employment. And now is the time to start learning these skills. It's not the time to sit back and wait for the crisis to happen. It's the time to prepare while things are good, so that if things continue to be good, you're going to be in a really great position anyways. But if things turn south really quickly, you're already set up, you've already got the skill set, and you're already in a financial position where you can take advantage of the next big depression, or should I say opportunity. The 1929 crash wiped out 86% of investor wealth. 2008 erased $8 trillion in value. The dot-com bubble bust vaporized $5 trillion. And every single time, the smart money always saw it coming. They didn't just survive, they thrived. What did they know that others didn't? Well, today, I'm going to reveal the 4 unmistakable warning signs that preceded every major market crash in history. These aren't just theories. I'll show you the exact patterns backed by hundreds of years of market data that signal when the wealthy start quietly moving their money. By the end of this video, you'll know how to spot these signals yourself, and more importantly, how to position yourself and your portfolio to protect and potentially grow your wealth while others panic. But before we start, we need to understand the anatomy of market crashes. And let's start by looking at 1929 and the Great Depression. Markets peaked in September of 1929, but by 1932, 86% of the value in the stock market had been vaporized. It took 25 years from then to recover. Now, there were a lot of reasons why the stock market crashed in 1929, but the reason why so much wealth was wiped out was largely due to the fact that people believed that stocks could only go up in value, which led to a lot of risky behavior, like borrowing a whole ton of money in order to invest and not thinking about the potential repercussions. And that led to a very, very painful lesson that excessive leverage destroys generational wealth. Then fast forward to Black Monday, 1987, the largest single-day drop in U.S. market history. It was a 22.6% decline in a single day, largely driven by program trading that nobody even realized was a potential problem. But when the stock market started to fall, the market mechanics amplified that crash, making things worse and worse and worse. Then there was the 2000 dot-com bubble. The NASDAQ fell 76.8% from the peak. It took a full 15 years to recover. And guess what? Just like in 1929, it was fueled by the belief that tech stocks could go nowhere but up. And obviously, we all now know that this just wasn't true. And most importantly, especially for those who are investing in things like Bitcoin right now, you need to understand that the new paradigm thinking proved dangerous. Because even though the dot-com stocks were something that had never been seen before, and Bitcoin is something that has never been seen before, we have many times over history seen people believe that this new thing is the next big thing, only to not see the massive failure that's right around the corner. Then there was 2008, the financial crisis. The S&P dropped about 50%, $8 trillion in wealth was destroyed, and this was the single biggest meltdown in the US economy and the global economy since the Great Depression. And ironically, it was also triggered, much like Black Monday, by something that nobody saw coming. Well, there was a few people that saw it coming, but most people, 99.99999% of people, didn't see it coming. And it was subprime mortgages. And more specifically, complex financial instruments that hid massive risks, just like the complex trading systems of Black Monday in 1987. And most recently, there was the 2020 COVID crash, the fastest 30% drop in history. Now, the one big thing here is we had seen big drops in the past, and the government arguably knew what to do, kind of. And there was an unprecedented government response. Money was flooded into the economy in order to make sure that the economy didn't completely implode. But the important lesson here was that an external shock, something nobody expected, a global pandemic, could lead to a significant crash pretty much overnight. Because while on March 10th everything seemed fine, by March 15th it was clear it wasn't. And this demonstrated how volatile and how vulnerable markets can be to things that nobody sees coming. But even though nobody saw these things coming, there were definitely clear warning signs. So in all of these scenarios, the thing that tipped the scales was unpredictable. However, there were warning signs in every single scenario that something bad could occur if things just went slightly the wrong way. And the first big warning sign is overvaluation. In almost all of these cases, the Buffett indicator, the total market cap to GDP ratio, was way out of whack, well over the 140% danger threshold. Now, what's the total market cap to GDP ratio? Well, that is the market cap, the value of all US stocks combined relative to the GDP, so the production of the United States economy. And when that market cap starts to exceed the GDP, that's usually a sign that danger is right around the corner. It's a sign that investments are way too expensive. And I'm not even going to tell you what these numbers are right now because they're absolutely insane. But go ahead and search Buffett indicator and take a look for yourself. Then there's the second massive warning sign, and that's excessive speculation. This is when people start borrowing money to invest in things. They do things that are crazy, like pull money off of credit cards in order to buy Bitcoin because they think that they just can't lose, even though it's going to cost them 20% a year to borrow that money off the credit cards. Now, that can be compounded by things like risky derivatives or other types of crazy investment strategies that people just tend to not understand. And when people start talking about the new trending way to invest that is really incomprehensible to most people, it's usually a sign that things are getting crazy. And then when your taxi driver or your barber or some other person that shouldn't be providing investment advice starts telling you about this new investment you need to invest in, well, that's also usually a sign that things are getting overheated. And it's not just stocks. It can be things like Bitcoin. It can be things like gold. It can be things like housing pre-2008, where everyone thought that houses could only go up in value. When everybody starts doing it, it's usually a sign that a house of cards is about to fall. Then there's the next sign, market euphoria. This time is different narratives. Like I mentioned previously, the taxi drivers giving stock tips, media celebrating new highs, $84,000 for Bitcoin, or a new record high almost every single daily in the S&P 500. And it's when this stocks or investments only go up in value mentality is at its frothiest that you need to start paying attention. As we're filming this video, the only go up mentality would be something that I might apply to things like gold and Bitcoin. And then last but not least, there's the volatility patterns. You start to see increasing market swings, big ups, big downs, frequent 1% daily moves, and trading volume spikes out of essentially nowhere. And when all four of these things start to happen all at one time, it usually means that one little thing, one negative piece of news, could have catastrophic results on the market. So if you start to see things like overvaluation, excessive speculation, market euphoria, and crazy volatility all at the exact same time, well, it's definitely time to make sure that you're diversified and not putting all of your money into the things that are seemingly too good to be true, because they probably are. Now, these are the warning signs, but the next thing we need to talk about is the psychology of these market crashes, because the psychology is actually the most important piece. So when you look at the market psychology right before a crash, there are certain things that lead really good people to lose a lot of money. And it's important to check yourself at every stage of your investment journey to make sure these things aren't driving you. So for example, if there's the fear of missing out, you didn't get into an investment 2 or 3 years ago and everyone else has gotten rich, and you're thinking about putting your money into the thing that's already been driven up in price, it's probably a good sign not to invest in that thing, or at least be cautious about the amount of money that you do invest. Or when you're looking at potential investments and you're going, I have to get in because if I don't, I'm going to get left behind. And you start to ignore rational analysis and all of the reasons why you shouldn't that are clearly right in front of you. Things like investing in real estate when it is at the top of the market and everybody is bidding for properties and paying way too much for them. And then there's the herd mentality. And this is even more important when you're following everyone else, because if you are just getting in as the last of the last get in, it's going to be too late. And when that moment of fear, that news article, that thing that nobody expected hits the news, that's when the panic selling starts. And that's when people start to lose the most money. So the question is, how do you protect yourself? And the answer to that is really simple. You diversify your investments for risk. You make sure that you are never all in on one type of investment. You take lessons from guys like Warren Buffett, who, when his Apple stock went up so much in value that it made up 50% of his portfolio, he started to sell it so that if it went down, it didn't take the whole portfolio with it. Because here's the real secret to building wealth. It's actually not losing money, protecting yourself from the big drops. And the way you do that, like I said, is by diversifying your portfolio, not for different types of investments, but for risk. And the best way to do that is, at least as far as I can tell, with the all-weather portfolio. So the all-weather portfolio, made famous by Ray Dalio, seems to be the best way to diversify yourself for risk. The strategy is simple. You put 30% in stocks, 40% in long-term bonds, 15% in intermediate bonds, 7.5% in gold as crisis insurance, and 7.5% in commodities. And all of these investments that are balanced, like I said, for risk, have a different function in the portfolio. Stocks are there for long-term growth. Bonds are there for deflation protection. Intermediate bonds are there for stability. Gold is there for crisis insurance. And commodities are for inflation protection. And when things like stocks start to crash, other investments tend to go up in value. And by using something like the all-weather portfolio and rebalancing regularly, you put yourself in a position where the crashes in any single investment tend to not have as big of an impact on your portfolio. And the reason why this seems to work is because it balances your risk exposure. As one investment perhaps goes down, others make up for it. And it's also designed to perform in all economic environments. So if there's high inflation, it works. If there's deflation, it works. If there's high growth in the economy, it works. If there's low growth in the economy, it works. The balance simply makes it less volatile. And most importantly, especially for amateur investors, is it reduces emotional decision making. All you do is rebalance your portfolio once a month or once a quarter or once a year, which means you're always buying the things that are the best deal, that have gone down in value, and not when they're the most expensive. And this is why this portfolio tends to have the most success through crashes. Now, on top of that, it's important to also make sure that you're always investing in it. Do what's called dollar cost averaging, which means every single month when you get paid, you put a little bit more into the portfolio. You buy the things that are the best deal and leave the things that are getting more expensive alone. This removes the pressure of trying to time the market, trying to buy at the right time or sell at the right time. You're simply buying the stuff that is out of whack with respect to its portfolio value. And when bonds drop or stocks drop or gold drops or commodities drop, guess what? You're buying those things and you're taking advantage of the reduction in the prices. And this is why it reduces the overall risk. And at the end of the day, it's this kind of systematic investing that makes people wealthy. Because the wealthy, in reality, don't get rich by predicting crashes. They get rich by being prepared for them. They get rich by having a portfolio that's designed to take advantage of when people are fearful. And while history doesn't exactly repeat, it always rhymes. And if you can always be prepared for the next market crash by having a portfolio that is set up in a way that you can take advantage of lower prices when they make themselves available, that's how you win. A tulip for the price of a mansion. A company valued at billions of dollars just because it has .com at the end of its name, or a JPEG of a monkey valued at $1.3 million, all completely worthless within months. For centuries, markets have followed the same pattern before disaster strikes. The Dutch saw it in 1637, Wall Street saw it in 1929, and the world saw it in 2008. And right now, these exact same warning signs are flashing. In fact, they're almost always flashing with some sort of asset in the market. But here's what everyone misses. The signs of a bubble are always hiding in plain sight. And in this video, I'm going to show you what history's biggest market crashes have in common and why these patterns matter more than ever today. But before I get into it, my name is Nolan Matthias, and if you want the truth about finances, the real truth, no BS, and you believe that there's always opportunity in crisis, then this is the place for you. So do me a favor, hit the subscribe button and hit the like button so more people like you can see this video. Okay, so let's get into it. It's clear that bubbles are always happening. At any given time, at least as long as I've been alive, and probably as long as you've been alive as well, there's always been some form of asset bubble forming. But it's usually far too late before we even realize that it's happening. But the question is, why do these bubbles form and why do we always miss them when in hindsight, they seem so obvious? And a better question is, what things are happening right now that are likely bubbles that we need to be paying attention to before we dump every single penny we have into those assets? And in order to understand this, we need to understand the historical patterns that always lead to a bubble. They've been the same throughout history, whether it was tulips in Holland, 1929, or the major financial crisis of 2008. And the question is, why do bubbles keep happening throughout history? Well, the answer is really simple. Economic cycles tend to recur over and over and over again, with different assets replacing the ones before it. And the human psychology that we have yet to shake is our biggest downfall when it comes to investing. And that psychology most often is driven by greed and a belief that this time is different. I mean, just think about it. During the .com bubble, how many times did you say it's different this time? And during the run-up in housing prices leading up to 2008, how many times did you hear people say, whether it was on the news or in person, that housing prices can't go down in value because everybody needs a place to live? Or when everyone's been buying Bitcoin and they seem so certain that the US dollar is almost certainly going to crash and that the decentralization of currencies is almost completely a certainty. But the reality is this time is almost never different. Even though it may seem like it's going to be different leading up to the inevitable crash, it almost never is. But it's not only the belief that this time is different, it's also the belief that there's going to be a new paradigm. And this is a new paradigm every single time an asset seems like it is going to go to the moon. There's always that psychological allure of new trends like electric cars and Tesla, which, by the way, I'm still not entirely sure that it makes sense to burn coal and natural gas in order to fuel our electric vehicles. How is that any better than the gas that is currently being used? Or then there was the Dutch tulip mania, which is completely insane in its own right when you think about the fact that tulips were so valuable just because they had some weird color profile and they represented wealth. Clearly, a flower that anybody can grow is not something that is going to sustainably be valuable. And then there, of course, was the .com bubble bust and the crypto boom. Don't even get me started on all the .com companies that were valued at billions and billions of dollars with no real logical sense. In fact, to this day, the only one that really survived was Amazon.com. And it seems that the reason why it was the one that survived was because it was actually the one that actually had a real business model and wasn't just built on hype. And that hype, the lack of a business model and the hype associated with different types of investments is a key indicator in why bubbles form and eventually crash. And here's the thing, a bubble bursting is almost always predictable if you're looking for the right things. And sometimes looking for the right thing simply means not investing in something that seems like it is crazy, even though there is the chance that it may not in fact be a bubble and you could make an insane amount of money from it. And the 5 stages of every bubble forming are displacement, a new innovation or paradigm shift, the shift from fiat currencies to independent currencies like Bitcoin, for example. That's a new innovation. It's a paradigm shift. But the thing that would make it sustainable, which is the actual crash of the US dollar and fiat currency around the world, is something that is a risk, yes, but everybody who is investing in Bitcoin and other cryptocurrencies right now is acting as if it is a certainty. And the reality is, it's not. Could it happen? Yes, but putting every single dollar that you have into cryptocurrency because of something that might happen is a fool's errand. Now, that's not to say that you shouldn't be putting a little bit of money into it, but the people who are borrowing or putting every penny that they have into it are taking a major risk. Then you've got the boom cycle. Prices start to rise slowly. Think about housing prices in 2001 that slowly started to rise and really ramped up in 2005, 2006, and 2007. They gained a lot of momentum, and that momentum led to euphoria. FOMO kicks in, the greater fool theory dominates, and everybody has to not only own a home, but own multiple homes. And when you start hearing things like taxi drivers own entire cul-de-sacs of homes in Texas, well, that's usually a pretty good indicator that things have gotten out of control. Now, the one thing that most amateur investors don't see is that when the smart money quietly exits, they start taking their profits. And we've seen this in things like GameStop. We've seen this in things like Bitcoin. We've seen this in things like the dot-com bubble, where the smart money takes a significant amount of their profits off the table in order to lock in the gains. Because the smart money realizes that diversification is all about diversifying risk. And when too much of their portfolios gets invested in any single asset, they pull money out of that asset, not because they are necessarily thinking that the investment isn't a good investment anymore, but they see that their risk profile has exceeded what they want it to be, which is when they start to pull the money back. And this inevitably leads to panic, because eventually, when people notice that the smart money is leaving, it leads to mass selling of all the rest of the investors, and that leads to the price collapses. And this happens all the time throughout history. I mean, just take a look at this chart of different asset bubbles over the last 45 years. You see gold in 1977 to 1981, and yes, indeed, gold can be in a bubble. In fact, it may very well be in a bubble right now. Even though it is deemed to be something that is an investment that only goes up in value and is very safe, the reality is it isn't. And in many cases, it has lost a significant amount of its value in a very, very short period of time. This hasn't just happened once in history or twice. It's happened many times in history. Then you've got the tech bubble in 2001. You've got US home values in 2006, 2007. You've got the oil bust. You've got Bitcoin in 2017, 2018. And we very well could have a new tech bubble in 2024, 2025. But here's the thing. It's hard to determine when it is a real asset bubble and when it is actually a bubble that's sustainable. And in the absence of being able to have a perfect crystal ball, I'll talk about how to protect yourself a little bit later on. But before we talk about that, you need to understand that it's the same story every single time. There's similar patterns, similar warning signs, and quite often they are ignored. So when it comes to investing, there are questions that you should probably ask yourself before you make an investment in anything. The first is, are the increases in the value driven by irrational exuberance? Now, this was a term that was coined by Federal Reserve Chairman Alan Greenspan. And what irrational exuberance refers to is the excitement around an asset class that just seems to be abnormal. And the second question is, are the rise up in these values sustainable? Because quite often, if you just ask yourself these two questions, it can become clear if something is in fact in a bubble. And not only that, it can become clear long before the bubble ever bursts. So let's talk about how to recognize bubble peaks. The first thing you need to look for is widespread speculative activity. There's a difference between investing and speculating. Investing is a long-term strategy where you're looking for things that are undervalued that will continually go up in value. Speculation is when you are investing in something or betting on something that you hope will go up in value quickly and make you rich. And when people start looking at an investment as a speculative investment, one that they think that they're going to shoot the moon on, that's usually a good sign that we're in a bubble. And then on top of that, when it starts getting to the point where there's media coverage around an asset, and it seems to be getting to the extreme, and things are being said like, could anything stop real estate? Can anything stop Bitcoin? Can anything stop tech companies? That's usually a pretty good sign as well that we're heading towards the top. But here's the big thing. When normal people, average people, start making very risky investments in an asset class, that's the time where usually you need to pump the brakes, especially in times where people are not only making those risky investments, putting their life savings into an asset, but also doing it with leverage, borrowing money in order to put more money in because they hope that it's going to be their one shot and done, and because they have the irrational belief that there's no risk involved. And let me tell you this, anytime you borrow money to make an investment, there's not only risk involved, but you're increasing your risk exponentially. So here's the things that you need to look for when it comes to identifying bubbles. The first is the everyone's getting rich effect. So if taxi drivers start giving stock tips like they did in 1929, or Uber drivers like they did in 2017 with respect to Bitcoin, or the pizza delivery guy is flipping houses in 2008, or teenagers are becoming crypto millionaires in 2021, investing in things like Dogecoin, which is absolutely absurd, that's usually a pretty good sign that a bubble is about to pop. Anytime that everyone is talking about something like it cannot go down in value, that's when you start needing to head for the exit. Then when there's dangerous financial innovation, things like margin trading in 1929, collateralized debt obligations in 2008, which by the way, nobody really knew about these until after the financial crisis, or NFT-backed loans. So in other words, lending against the value of things like JPEGs of monkeys, for example, or you start seeing complex financial instruments making speculation easier. These dangerous financial innovations are a sign that things are going to get exponentially worse really quickly. Then there's my favorite. It's the change in media coverage, the transformation in how the story is told. Take, for example, cryptocurrency. Phase one, skepticism. You had every major politician out there going, Bitcoin is fake, it's not real. And well, yes, it very much did become real. Then you started seeing curiosity. Could Bitcoin actually be this thing that takes over from the US dollar? Then you started seeing enthusiasm. Bitcoin goes to the moon. Then euphoria. Bitcoin can't be stopped. And then phase five, which is the to the moon. Another new record hit, another new record hit, another new record hit. But all the while this media coverage is happening, there is some significant signs that the value of these investments can't continue to go up forever. And this is the mathematics of impossibility. Take, for example, the 1990s. The real estate of Japan was valued significantly higher than all of the real estate in the US. Or in the year 2000, when dot-com companies were worth more than traditional industries. So you had a company that literally had no assets and no products being worth more than a company like Ford or GM. Or in 2021, when the total market cap of Dogecoin was worth more than many Fortune 500 companies, which was absolutely ridiculous. I mean, think about it. This was literally a cryptocurrency. That was a joke. It was a dog cryptocurrency that somebody made as a joke that became worth more than Fortune 500 companies. Talk about irrational exuberance. And this is where the modern bubble indicators come into play. Anytime there's high leverage ratios, so in other words, people are borrowing to buy, there's a disconnect between prices and fundamentals or even reality, or there's risky financial behaviors, those are bubble indicators. The second you hear about somebody investing everything they own in a hyped up stock, that is the time to get out and run for the doors as fast as humanly possible. Now, even though in hindsight it's always obvious when a bubble occurs, it's not always completely obvious while it's happening. So let's talk about how to protect yourself from a bubble. So the first thing you need to do is be cautious when everyone else is optimistic. If everyone is talking about something and there's seemingly complete and unanimous certainty around the value of that investment, it's probably a sign that things are about to turn. And most importantly, you need to start looking at every single investment and try to determine whether it is overvalued relative to pretty much everything else. Take, for example, Tesla, which for a long time was valued at significantly higher than many other car companies, even though their revenues were nowhere close. So recognizing when something is clearly overvalued is one of the keys to making sure that you can get out of it before it comes back to its inherent value. And then you want to make sure that you're diversifying your investments. And again, diversifying investments isn't about owning a whole bunch of different stuff. It's about diversifying your risk so you're not overexposed to anything that may be overvalued. Because even if you can't recognize that something is overvalued, if you are diversified and an overvalued investment goes in the tank, well, the rest of your investments, at least hopefully, will help you ride out the storm. So let's talk about diversification. So diversification is all about risk mitigation. You need to spread your investments across assets and avoid putting all of your eggs in one basket. So in other words, let's say you do invest in one of these things that has a bubble forming. Now, it's one thing to let your winners ride, but it's another thing to let the entirety of your net worth be exposed to one individual asset or asset class. So what you need to do, even though it may seem hard at times, is start taking profits from those things that start to dominate your portfolio. There should never be one stock or one asset class that holds up a significant portion of your net worth. So for example, let's say you had invested in Bitcoin in 2014 and it ran to the moon in 2017, and now you found that you had a significantly higher net worth, but almost all of it was in Bitcoin. That would have been a very good sign that you should be selling a pretty significant portion of your Bitcoin holdings in order to invest in other things that weren't A, as risky, and B, minimized your exposure in the event that Bitcoin, like it did, went down in value. So let's say you had invested, $10,000 in Bitcoin and it became worth $3 or $4 million. Wouldn't it have made sense to take $3 of that $4 million off the table, invested in other things that were completely uncorrelated from Bitcoin so that you wouldn't find yourself in a situation where your money disappeared pretty much overnight? I think the obvious answer is yes. And the same goes for things like gold, because right now many people have been investing all of their money into gold, thinking, hey, central banks in other countries are buying up all the gold, it's going up in value, and it's one of those assets that can never go down. So I'm just going to keep all of my money in there, thinking that it can't implode. And as we saw in the 1980s, it absolutely can. So if you've had a big run up in the value of your gold holdings, yes, it absolutely makes sense to take a little bit of the profit and make sure that you're not overexposed to that one asset. And the same is true for stocks, the S&P 500, bonds, and everything else. You should be using something like the all-weather portfolio, where you are diversified so that when one asset class finds itself in trouble, the other ones keep you afloat during the times when you're losing value in the other things. And this is where it gets really difficult, because the hardest thing to do is to decide whether or not you should let your winners ride or whether or not you should take profits. And it's my belief that you should absolutely let your winners ride, but only to the extent where they don't dominate your portfolio. And when you do have an investment that has done very, very well, I'm also a believer that unless it is very clear that it's going to go to zero, you shouldn't necessarily take all of your money out of it. You should just take enough out to mitigate your risk. But more importantly, it's also important that you avoid taking on any debt in order to invest in risky assets, and you need to focus on long-term stability when it comes to your investments. It isn't about finding that one thing that shoots to the moon. It's about doing the same thing for a long period of time and making sure that your risk is mitigated. Because money is one of those weird things. You can with certainty become rich if you just take a little bit off the top and invest it every single month for your entire lifetime. But if you're taking big risks on any sort of investment that is deemed to be one of those investments that can only go up in value, well, the chances of you hitting a home run is probably pretty slim. But if you constantly are hitting base hits and you hit enough of them, you can definitely build wealth over time with complete certainty. That's why there are janitors and people who work at McDonald's for 20 or 30 or 40 years who end up being millionaires. It's because small little investments over time create complete certainty in the fact that you're going to build wealth. But trying to hit home runs has a similar level of certainty, but it's more likely to the opposite effect that you're going to go broke. And this is where it gets important to have recognition tools at your disposal. Using fundamental analysis, looking at stocks and going, does this seem to be too good to be true? Looking at price to rent ratios and noticing that it is way more expensive to own a home than it is to rent is usually an indication that a housing market is overvalued. And understanding basic risk assessment frameworks. If I have all of my money in this one thing, is it going to put my portfolio at risk? And am I going to end up broke as a result? Maybe the answer is yes, maybe the answer is no, but it's pretty simple to diversify in order to make sure that the answer is with certainty no. And when it comes to investing in stocks, for example, it's pretty simple to analyze company financials. You want to look for stable earnings. You want to avoid hype-driven stocks. You want to make sure that the price to earnings ratios are in line with where they should be for the industry, and make sure that there just isn't anything funny going on with the company. And one of the easiest things you can do is take a look at a stock, compare it to what's going on in other stocks that are similar, and see if things make sense. For example, as of this filming, there is a real estate company that is significantly smaller than Remax, but it has a valuation that is significantly higher than the biggest real estate company in the world. So if that's the case, it becomes pretty clear that it is a hype-driven stock, not a fundamentals-driven stock, which means that you should be able to avoid what is pretty clearly a bubble in that stock. But here's the most important part. It all comes down to prudent investing, avoiding the herd mentality, focusing on fundamentals, and remembering long-term goals. And there's two things that one of my mentors once told me that have kept me from losing big amounts of money on any one thing, primarily because over my entire investing career, I've never invested a significant portion of my money in any one thing. Those two things are this: be fearful when others are greedy. And by the way, this is a Warren Buffett quote, and greedy when others are fearful. So in other words, when things are going down in value, that's often a really good time to buy. But on the way up, it can quite often be the beginning of the end. And never invest in anything you do not thoroughly understand. And what he meant by this is if you don't understand the fundamentals of what you're investing in, it's probably a bad idea to invest in it. And at the end of the day, it is your responsibility to understand the things that you invest your money in, not your stockbrokers, not your financial advisors. You need to understand where your money is going, whether it's the right investment for you, and whether your risk tolerance supports you making that investment. And unfortunately, this isn't like a video game where we get the rules and we get the instructions at the beginning and we know how to play and what the objectives are, because school just simply doesn't teach us that. We have to learn for ourselves what our objectives are, and then we need to do whatever it takes to learn the things we need to learn in order to meet those objectives. The responsibility completely lies with us. And the key thing is to make sure that you don't find yourself overexposed in the middle of a crisis. Every real estate crash looks different until you zoom in on the moment right before it happens. Prices surge, and then, boom, demand vanishes. But ask yourself, why do buyers disappear overnight? Why do mortgage delinquencies quietly rise while headlines scream hot market? And why does it always feel safest right before the fall? If you're seeing these signs now, you're not paranoid. You're early, and that, it could save you a fortune. This is what always happens right before a real estate crash. Okay, so let's jump right in and talk about the three things that always affect housing prices. And while this might seem like it's an oversimplified explanation, believe me, these are the three things that you need to pay attention to. The first is interest rates, the second is wages, and the third is consumer confidence. And these three things largely dictate supply and demand. Now, there's other things that play in, things like domestic migration, but for the most part, these are the three primary things that will affect everything else. And to put this in perspective, low rates, well, they increase demand and they decrease supply. The lower the rates, the more people want to buy, the more comfortable people feel buying, and ultimately, the less supply there is because there's so many buyers. People want to hold on to their properties, people start investing, and subsequently there becomes less available on the market to buy. And of course, the inverse is true for all of these as well. If rates go up, demand decreases, supply increases because everyone's worried that they aren't going to be able to cash out their property, and so on and so forth. Then there's falling wages. This increases supply. As people are no longer able to afford their properties, they start to come onto the market. And at the same time, when wages are falling, it's usually because there's something bad happening in the economy and people get scared, which decreases demand. And then last but not least, there's consumer confidence. This is usually the thing that shifts last, but everything adjusts accordingly and it adjusts quickly, just like it did in 2008 and during the early pandemic and throughout the pandemic as prices went through the roof. But the pandemic's actually a really good example because we saw ultimate fear where people were putting their houses on the market. They wanted out because they were afraid that they weren't going to have wages, only to find out that there was an unlimited money printing machine and that they were actually going to have a stable income combined with lower interest rates because interest rates went down to prop up the economy. And that led many people to not only jump into the market or buy bigger properties, but also to invest in properties, which meant there was less supply because there was so much demand that those properties were getting scooped up and turned into things like rentals and Airbnbs. And if we look throughout history, you can see that it's always these three things. In the 1980s, there was inflation and the Volcker rate hikes. Inflation surged, the Fed had to raise interest rates above 17%, and mortgage rates subsequently became unaffordable. So housing starts and housing values dropped significantly. It led to a crash. Then, just a short time later, there was the savings and loan crisis of the 1980s and the 1990s. Financial deregulation led to risky lending. People were buying properties that they couldn't afford. Savings and loans institutions started collapsing, and the credit crunch, which was caused by there not being enough wages to afford the houses that people were buying, contributed to the 1990 and 1991 recession. Then there was the 2008 subprime mortgage crisis, where there was widespread risky lending. Everyone believed that prices could only go up. And when the bubble burst, defaults led to not only a recession in the US, but a global financial crisis, causing home prices to fall 20% or more in many markets. And not only that, there was a massive amount of people who lost their homes. And then last but not least, there was the pandemic boom and the subsequent correction, where low interest rates led to high demand, and that fueled a surge in home prices. But those prices peaked in 2022 and then declined as interest rates went up and cooled the market. That led some markets to see 20% plus declines in home prices. And it was really simple. Interest rates went down, people got excited and bought homes. Then they started going up, people got scared, started selling homes and stopped buying. And it's the same pattern that repeats over and over again. The only difference is what caused the major change in consumer confidence. And most of the time, there were indicators that foreshadowed what was about to come long before it actually happened. So let's take a look at indicators that foreshadow a crash. Now, one of the most often cited indicators of properties being overvalued is the price to income or price to rent ratios. When the values of properties typically go above 5 times what incomes are, people think that properties are largely overvalued. And many will point to this ratio to signal that there's a disconnect from fundamentals. They'll also suggest that these high ratios often precede corrections. But you have to be really careful with this indicator because it's not actually a really accurate indicator. What's more accurate is mortgage debt service payments. Because what happens is when interest rates go down substantially, the monthly costs associated with owning a home also go down. And this creates bandwidth for housing prices to increase. There's a general rule of thumb. It's called the 1%, 10% rule. For every 1% reduction in interest rates, there's an increase in affordability of about 10%, which subsequently means that there's a 10% tailwind with respect to housing prices. Because if everyone can afford 10% more with respect to the price of a property, because interest rates went down, which allowed borrowers to borrow more money, well, that's going to increase the potential value of properties. And you can go back in history, and this rule almost always holds true. And the reason why is because it's just simple math. And if you look at this chart, which is the home price index versus debt service ratios, what you can clearly see, it's mortgage debt service ratios going up substantially that actually leads to price corrections. And there are times, like right now, where home prices from a price to income ratio have gone up significantly, but the debt servicing ratios are still at historical norms. And this again is because price to income ratio isn't a really good measure of whether homes are overvalued. How much people are paying for homes out of their monthly income, that is a significantly better indicator. Now, the next indicator that could indicate a crash is coming is when there's rapid price growth. When prices are rising faster than wages, this signals unsustainability, especially when interest rates are flat. And double-digit annual growth in real estate values are often unsustainable, especially if interest rates haven't gone down substantially. And this leads to an affordability crisis. And as you can see from this chart, home prices are actually a lagging indicator of real household incomes. And real household incomes are incomes when adjusted for inflation. So when the amount of money that you have relative to the cost of living is going down, this typically is an indicator that somewhere down the road, housing prices could go down as well. You can see it clearly here in 2007, and then you can see it again in 2019, 2020, 2021, with values coming down 1 to 2 years later. Then there is lending standards. This, by the way, in my opinion, is the single biggest indicator of a crash that's about to come. When credit risk starts to go up, that means that money is being lent to people that cannot afford to repay it, which is ultimately going to lead to catastrophe, both for the individuals that the money was lent to who couldn't afford it, and potentially for the greater market as a whole. And these risky lending patterns include things like an increase in subprime loans or low down payment loans. They also include things like risky products like ninja loans, no income, no jobs, no assets, and ARMs, adjustable rate mortgages, where the payments and the interest rate resets 2 to 3 years later, causing payments to go up and leading to personal financial ruin. This, by the way, is exactly what happened in 2008 and pretty much every housing crash before it. It was almost always the risky lending due to more money being available to lend that caused the housing market to reset. And the data here is clear. It is very rarely the interest rates that cause the crashes. It is when mortgage debt service payments become too high because of risky lending that causes mortgage delinquency rates to go up, which ultimately causes pretty much every crash. It's the inability to have the income to pay the mortgage that you got that leads to personal financial crises, and when done en masse, leads to national real estate crises and potentially global ones, like in 2008. And in almost every case, you can see this coming, especially when it comes to monetary policy. If there's going to be significant reductions in interest rates, we're probably going to see a run up in prices a few years later. But then when the tables turn and interest rates go up, this is going to reduce affordability, and it's going to lead in all likelihood to a correction, especially if it's not done slowly. And the evidence here is clear. It was the trigger for past crashes like the 1980s and 2008, and it's also the reason we saw such a big correction after the pandemic. And this is really the graph that says it all. When you start to see interest rates come down, as you did after the financial crisis, you start to see a period where housing prices are going to go up. And ultimately, when interest rates turn and they start to go up, well, that too will inevitably cause a correction in prices. So a graph like this, where you see interest rates that have gone up over the last several years, will typically be followed by a graph where prices come down. Now, that doesn't mean there's going to be a crash, but it almost certainly means there's going to be a correction. And by the way, the national housing market is not one housing market. It will be different for every single housing market across North America, depending on the demographics, domestic migration, and what's going on in each individual city. That's why places like Texas, when there's a recession, perform better than the rest of the country. And by the way, in the same way, when there is an oil price crash, Texas suffers and other parts of the country do well. This is also what causes a lot of domestic migration. When things get way too expensive in California, people look for greener pastures. Companies look for greener pastures. And that is the real tale of the real estate market. People will always gravitate to places that have better economic circumstances, the prospects of higher wages, or lower costs of living. And then last but not least, there's always inventory. Now, one might suggest that inventory plays an important role in housing prices as well. But inventory, again, is a lagging indicator. It's a lagging indicator of demand that ultimately comes from consumer confidence and interest rates. Because quite often, homes that get built are built based on the economics of a year or two prior, not when they actually become occupied. So if there's rapid building in a real estate market, and then all of a sudden the economy in that same market turns, that market could find itself with an imbalance of supply and demand because the economics of building were based on what was going on before in the economy, not what's going on right now. And in contrast to that, unfavorable building conditions because of a downturn in the economy could see there not be enough properties available for sale when the market does get better. But in many cases, the building that was deemed necessary when times are good is completely unnecessary when times get bad. And this leads to rising unsold inventory, which weakens seller leverage and leads to lower prices. And again, you can see this clearly in the charts. When home sales are really high, home prices tend to go up. And when they start to fall, well, the home price index no longer goes up on a steady upward path, it starts to waver. And eventually, if things don't turn around in the economy, it could turn the other direction. So the question is, how do you prepare for the inevitable crash or the inevitable correction? Well, it's really simple. Always buy within your means. Avoid stretching your finances. Even though if it feels like you can afford it right now, always give yourself some breathing room. And definitely avoid speculative buying. The worst time to buy investment real estate is when everybody else is doing it. The best time is actually when prices are coming down, but that's also when everyone's too scared to do it, so nobody does it. Then you want to make sure that you focus on affordability and personal needs. Do you really need that McMansion? Or can you live with something smaller that, by the way, is probably not going to be as hard to clean because it's not as big, but that is significantly more affordable and won't find you in a financial crisis when the economy does turn? So this is really simple. Buy properties that will still be safe during downturns, and do that by buying properties that are affordable. And if you can't afford the home that you think that you need, don't push yourself to buy it. That's usually a pretty good sign that prices are going to turn at some point. Just wait for them to come down, like many people did in 2023 and 2024, and you'll be significantly happier that you did. Then it goes without saying, and this is for the American audience, not necessarily the Canadian audience, which, by the way, 5-year fixed mortgages in Canada are essentially adjustable rate mortgages. The US has the unique ability for mortgage borrowers to borrow with 30-year fixed loans. And this protects you from rising interest rates, in contrast to those adjustable rate mortgages that could see your interest rate go up significantly and cause you significant financial pain. So having stable monthly payments that you know that you can afford for the long term ensure that if the economy does get bad, you're not going to lose your home. So it's important to avoid all of these exotic loans. Keep it simple, fixed rate mortgages, and make sure that you're buying something that you can absolutely afford, even if your income falls by 15 or 20%. And not only is it important to only buy a home that's affordable in the long term, but to also build financial resilience. Now, if you have 100,000 or 200 or 300 or 500 or a million in investments, you probably don't need to worry about an emergency fund. What you actually need to worry about is making sure that you protect your money so that you don't lose it. But if you don't have any cash on hand and you own a home, you need to be doing everything you can in order to get a 3 to 6 month emergency fund. In addition to that, whether you own a home or not, you should reduce high interest debt. If you have credit card debt, that should be your single biggest financial priority. And that will help you build and keep strong credit, which ultimately allows you to get better loan terms when you do go to buy that property, or if you need to go and refinance. But most importantly, and this is something that I think is lost on people, is you need to make sure you diversify your assets. Avoid having all of your net worth in real estate. Make sure you are balanced. You have stocks, bonds, cash. Don't just go and take every penny that you have and dump it into a house. Keep some in other types of assets so that if the real estate market crashes, you've got other investments that maybe aren't suffering as bad or are perhaps growing. And at the end of the day, we should always be hoping for the best, but definitely planning for the worst. And if you do so and things go well, you have nothing to worry about. But if things get bad, having a plan for the downturn, having a plan B is what will prevent you from losing your home and suffering. And I can't emphasize this enough. You need to be conservative with your future price assumptions, both from the perspective of how much income you're going to be earning in the future and from the perspective of where housing prices and interest rates and everything else will go. People make the mistake of creating a financial plan based on their expectations that things are going to get better, and they don't always do. Sometimes things get worse. So you need to be conservative with your financial projections when you're looking to buy a home, or for that matter, if you own one right now and it feels like you can't afford it. Because the next depression, the next recession might be right around the corner. And by the way, if you want to see what always happens right before a depression, make sure you check out this video right here. A lot of it is pretty similar to what happens before a housing market crash.